And I'll go ahead and record this just in case somebody wants to get back to it later on. Anything you want to review or get elaborated on, more in depth into? Or you're going to get that extra credit and not worry about this, right? And if there are no questions, this is going to be a short session.
I really wish you would touch on like basically all the equation formats that we're going to be going over. I mean, I'm not really struggling with anything except for the clock is my enemy, but.
Okay. All right, so let's go through chapters 1 through 5, some of the basic formulas. And by the way, can everybody come off mute so we can have a conversation? If we're all off mute, you can actually ask questions a little bit easier than having to find the unmute, mute, remute, whatever. Unless you get a lot of background noise, then you can go on mute. But otherwise, I'd like to have an open dialogue, an open conversation. So please do come off mute, and we can chat. So what equations might be most confusing to you, do you think? I mean, a lot of this is terminology, especially the first few chapters. So if I ask you for net income percentage or net profit percentage or net earnings percentage, they all mean the same thing. So anybody want to share how I calculate this percentage? It's our Walmart example. Walmart puts 2 cents for every dollar that you buy something. Harley Davidson puts 12 cents. Apple puts 22 cents. Anybody want to take a shot at what goes in the numerator, what goes in the denominator?
Revenue divided by expense.
What's that?
Revenue divided by expense.
If I take revenue divided by expense, let's try that out. Okay, so if I have let's go with an income statement here. I'm going to have revenue of $100 million. Cost of goods sold of $1 million. I'm going to have, who can tell me what the gross profit is?
Revenue minus cost of goods sold.
Good. Give me a number.
30 mil.
You got 30 million. I get SG&A, selling general administrative, of 20 mil. Who can tell me what the net income is?
10 million.
10 million. So that's a good start. That's our income statement. So my next question is, if I take revenues of 100 million divided by what expenses? My SG&A expense, my cost of goods sold expense, all my expenses? 70 and 20, that's all my expenses. I get equals 1.11. That's not going to give me a net income percentage. Let's try a different formula. We want to take a shot based on the income statement below. What's in the numerator?
Net income.
Net income, good answer. So if net income's in my numerator, and what do I have in my denominator?
Total revenue.
I'm going to say net revenue, but here it doesn't matter. But we're going to do net revenue. So let's try that formula. So I'm going to go with net income of 10 million divided by 100 million. The millions cancel out anyways, and I get 10%. Is that a better net income percentage or return or profit? Let me go ahead and create a balance sheet here, just to add additional confusion and hopefully eventually eliminate that confusion. So I'm going to have assets. I'm going to have, well, let's see. Also have cash of 10 million, accounts receivable of 5 million. I have inventory of, let's go with 10 million also. And let's go with fixed assets of 50 million for kicks. And then I'm going to have my liabilities. I'm going to have accounts payable. Let's say we're at, let's say, you know what? I'm going to change this just to make it round numbers. I'm going to add that to 30. And I've got accounts payable. Let's make that 25 million. Let's go with our, let's go unearned revenue. Make that 5 million and make that 20 just to make our numbers. I'm trying to get some easy numbers we can do in our head without doing a calculator. Okay. I'm going to go ahead and do common stock. Now let's do a bonds payable. Bonds payable of do 15 million. Assets here. Someone do the math quick. Total assets?
100.
100. 10 plus 30 plus 10 plus 50 is 100. Okay. And I'm over here, I'm at 40. I'm going to have common stock at 10 and retained earnings. Actually, I'm going to do common stock and additional paid-in capital. Combined at 10. How much should I have in retained earnings right now then, if I got to keep seeing the balance?
$50.
50.
Better be 50. Good job. Okay. I've got 50 out of here. Line this up a little bit, make it pretty. All right. So I'm looking at now, I've got 10% net income percentage. I actually have 30% or 30 out of 100 gross profit percentage. Not net income, but gross income or gross profit. This is net income or net profit. Okay, so you can call us whatever you want, but that's where we're at. So I might ask you for a gross profit percentage. You're going to say, okay, gross profit percentage is going to be gross profit over net sales. Right? Where my net income or my net profit percentage or my net return is my net income over net revenue or gross profit over net revenue. So we're at 30% for gross profit percentage. We're at 10%, that's telling me for every dollar of revenue, the stuff I'm selling costs me $7, 70 cents. And the profit I make from that's 30 cents. And then my administrative overhead is 20 cents. And I get to put 10 cents in my pocket. That's all that's telling me. It's telling me a story. That's how you're going to read an income statement. So I might ask some other formulas. Well, we know what our debt ratio is. What goes in my numerator and what goes into my denominator for the debt ratio?
Assets divided by liabilities.
Total assets divided by total liabilities. Let's try that out. What's my total assets?
100.
What's my total liabilities? These first three things, right?
Yeah.
Not the equity. So what's that total?
40.
40. So my debt ratio equals 2.5. That sounds kind of funky. That's kind of interesting. That's not going to quite work. I'm asking what percent of my balance sheet is debt? You got the right variables, but you got them in the wrong order.
Total liabilities goes in the numerator.
There you go. Total liabilities divided by total assets. Let's try that one. By the way, when you're taking a test, plug in some numbers and see what the heck works. So I'm going to take 40 out of 100. 40%. My debt ratio or my balance sheet is 40% debt. And if I do it the other way around, my equity ratio is 60% debt. So my debt ratio, also known as a debt to asset ratio, just calculating how much of my balance sheet is made up of debt. There is something called a debt to equity ratio. And at that point, you're putting debt of 40 over equity of 60. Okay, just put a slash. Whenever you see these ratios, put a slash there. Okay, debt to asset ratio. Just put a slash there. Debt in the numerator, liabilities. Assets in the denominator, and you're on your way. So there's debt to equity ratio. In this case, 40 to 60 equals 0.67. If I had 100 million in debt and 50 million in equity, I'd have a 2-to-1 ratio. My debt would be double my equity. But the debt to equity ratio here happens to be 0.67 based on the calculation. Now let's look at a current ratio. What goes into a current ratio? Two things. Anybody?
Current assets in the numerator and current liabilities in the denominator.
We got a winner. Okay, so let's see how that works out. Current ratio, what do I have for current assets? Somebody else. What's my total current assets in this balance sheet?
Would it be 90?
Okay, I get a vote for 90. How did you get that?
Accounts receivable plus inventory, and I forgot what FA was.
Fixed assets.
Okay, yeah.
Do fixed assets last more than a year? I sure hope so. So that's not current. But there are three things that are current assets here. Cash converts to cash within a year, obviously. Marketable securities, accounts receivable, paid. We might have deposits on rent. We'll use that up in a year. So these three things are my current assets. I have 50 million in current assets. Let's go there. I'll go 50 in current assets. My long-term assets are 50 here. That doesn't count. I'm just looking for current assets. What are my current liabilities? Which of these are going to get used up in a year? Show me with the count of fingers. How many items do I have here that are current liabilities? 1, 2, 3, or 4? Show me fingers. 1, 2, 3, or 4, please. Okay, current liabilities. Things in a year's time that are going to be used up. Well, bonds payable are usually long-term. That's like a 10-year bond, a 20-year bond. So if you held up 2 fingers, right on. You have accounts payable and unearned revenue. And how much of that, what do we got there? We got 25. So my current ratio is 2. Okay. That's my current ratio. I'm pretty liquid. And the current assets are the things that you have that can pay off your liabilities. Hopefully that's the bigger number. Hopefully you have more current assets than current obligations or liabilities to pay. So when we do that, you're going to say, okay, cool. I've got double my liabilities to pay off in the short term. I'll worry about my bonds later. I've got 15 million of those to pay off in 10 years from now. That's not current. That's not in the next year. Now the acid test is very similar, but it's going to be a smaller number. Acid test, also known as the quick ratio. It has quick assets by current liabilities. Which of those items would not be considered quick assets? I told you I had cash, receivables, and inventory in my current assets. One of those is not in our quick asset ratio. It's not as liquid as the other two. Can you tell me which one that is?
Inventory.
Inventory. So I'm going to take out inventory and I'm going to do 40 by 25. Okay. So if I calculate that outright, that's 8/5. So that comes out to 1.6 maybe, or something like that. Notice my current rate, my acid test ratio, quick ratio is smaller and always will be because it has less stuff in the numerator. So these are some basic analysis tools you have at your disposal that by now you should be feeling reasonably comfortable with. And by the way, oops, sorry about that. Working capital equals current assets minus current liabilities. Now let's do inventory turnover. We're covering a lot of ground here. What two things go into inventory turnover? I'll give you a hint for the first one. You tell me the second thing that goes into an inventory turnover. And yes, I expect you to memorize this particular form. Your receivable turnover and inventory turnover you'll probably see, and I expect you to memorize it.
Cost of goods sold over average inventory.
Cost of goods sold over which? Cost of goods sold, average inventory. Excellent answer. So what's our inventory turnover? Well, what's our cost of goods sold here? And by the way, I'm assuming beginning balance sheet and ending balance sheet are identical. So assume these are averages. Last year's cash was 10, receivables was 30, inventory was 10, and fixed assets was 50. So you don't have to go in and say, well, if my cash was 5 last year, now it's 10, that's a 7.5 average. No, I'm not going to worry about that right now. But you will need to know average when the time comes. So what's my cost of goods sold? Who can tell me cost of goods sold? It's right there staring at you.
70 million.
We got 70 million. What is my average inventory?
10.
10. So what's my inventory turnover?
7.
7. My inventory turned over 7 times during the year. I sold my inventory, my cost of goods sold. My inventory was 1/7 of that, it sold 7 times. Now I'm going to calculate days inventory. If I told you we had 10 turns in a year, you say, oh, I take my 365 divided by 10 and I get 36.5. But in this case, I have 365 divided by 7. Okay. So I got maybe 52 days. 365 days divided by a ratio. So what that's telling me, on average, my inventory is 100% sold every 52 days. That doesn't mean everything gets sold, by the way. That means some things will sell in 100 days, Some things will sell in 20 days. Some things will sell in 1 day, and some things will never sell. But on average, it takes 52 days to sell the 100% of my value of my inventory. Does that make sense? Are we on the same page? And I'm going to do one more here for receivables turnover.
Where did you pull that? Where did you pull that average inventory number from? The 10.
Oh, I see the inventory here at 10.
Oh, okay. I'm sorry.
So I said, if last year it was 20 and this year it was 10, my average would be 15. But I told you that my inventory on the balance sheet, my assets on inventory is the same last year as it was this year. So it was 10 last year, it was 10 this year, which obviously makes my average 10. 10 plus 10 divided by 2 is 20 divided by 2 is 10. Make sense? We're good? Please? Okay. So let's go ahead and look at accounts receivable turnover. I'm going to ask the same question. What two numbers go into an AR turnover? I'll give you the first one. AR. What's the second one?
Net credit sales in the numerator.
Net credit sales, okay, by definition. And I'm going to take the word credit out of here
Okay.
because, yeah, you know what? Walmart, they're not doing credit sales for the most part. Even a credit card counts as cash, by the way. And Food Lion's not doing credit sales. And Amazon's not doing so much in credit sales, although they do for Amazon Web Services and some of their other services. Apple does a lot of credit sales, though. They sell to suppliers. Harley Davidson does a lot of credit sales. They sell to their dealers, and they get paid later. So I'm going to take out the word credit here because, and we're going to assume all sales are credit sales. I hate to make assumptions of anything, but let's make we're going to make the determination. You see the word, you're not going to see credit sales on the problems. You're going to see sales. All right, so which is a bigger number, sales or receivables?
Sales.
Better be sales. Because sales goes up, 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 accounts receivable goes up, down, up, down, up, down. So what are my net sales? Somebody give me a number. What's my net revenue?
100 million.
I got 100 million. And what's my accounts receivable, average AR?
30.
30. So I calculate this out, I get 3.33. So, and I'm gonna put average here just for clicks. So what's happening? On average, I'm getting paid every how many days? I don't know, let's calculate that out. 365 divided by 3.33. Okay. And on average, I'm getting paid every 100 odd days. Okay, 100 points. Let's see. How many days is that? Divide by 3 times 3, 36, 18, 10. So every 108 days, 109 days. On average, every 109 days, 100% of my receivables are being paid. That's not to say everybody's paying me. Some will pay me in 30 days. Some will pay me in 200 days. Some I'll never see the money. But on average, I get paid every 109 days. Is that good or bad?
It depends.
Thank you. Good answer. I don't know. Last year, we were getting paid every 150 days or 200 days. Now it's 109. That's quicker. Is that normally good? Well, yeah, that's normally good. Would you rather that be 10 days? It depends. Uh-oh, it depends. Stop that it depends stuff. I'm getting tired of that. It depends on what? What's going to happen? If you say, I'm going to tighten up my credit policies, you got to pay me in 10 days. You're used to paying me in 3 months or 109 days, more than 3 months. But I need the cash flow. I've got a business to run here and I got to pay my employees not every 3 months. I got to pay them every other week. So what's going to happen? You're going to say, my policies are now net 10. Forget my terms, 210, net 200 or whatever it is, or maybe 260, net 9, net 100. I'm going in and saying, my terms are now net 15. You now have driven many of your customers away that can't pay you in 15 days. They may be buying stuff and it takes them 2 months to sell your stuff or 3 months to sell your stuff. And if it takes them that long to sell your stuff, then they're going to be able to say, okay, now I've got the money to pay you. If you make your terms net 15, you can make them whatever you want. It's your business. But if you make them too tight, you might cost yourselves sales. Does that make kind of sense? So we're painting a picture here of a company. We're looking and saying, you know what? I've got these ratios that are telling you a story. I've got these percentages that are telling you a story. I've got a balance sheet and income statement that's stating status of where we've been and what we've done, telling me a story. Does this stuff make sense? Okay. And I know, Emerson, that was a short question you asked and a long answer, but hopefully we're starting to fill in some of the blanks and make some more sense of this stuff. The other formula that you're going to really want to know, and yes, you've seen it before, statement of retained earnings. Beginning retained earnings. Tell me what I add to that.
Net income.
Net income, which happens to be plus revenue minus expenses. And then I get minus what? Get my ending retained earnings. What am I deducting?
Dividends.
Dividends. And you retain earnings. Okay. So that's our retained earnings formula, retained earnings statement stuff. So that's another good. Any other questions from any of the other chapters?
Can we talk a little bit about the adjusting book entries for sales returns and sales and credit?
Okay, so now we were kind of curious. So what happened when we get a return? Okay, let's go through that adjusting entry stuff. So let's move this out of the way. Let's see if we can put this down. Let's see if I can adjust the screen size a little bit. Wouldn't this be a nice crib sheet to have when you're done? All right. So what happens during the year? We sell $100 worth of stuff. Okay. 210 net 30. That means that if they pay within 10 days, how much am I going to get?
$98.
You're going to get $98. If they pay between 10 and 30 days or more, it's $100. At least, hopefully, you get paid. All right, so we get the journal entry on that. We're going to get accounts receivable for 100. We're going to go with sales revenue of 100. And now you get paid. And we determined we're going to get cash of $98. And the receivables has to be cleared for 100. Because there's $100 owed to us. So we got to figure out what we're going to do or how we're going to get this extra $2 into the mix. And we do that. We have two categories. We have returns and allowances or sales discounts. Which category is this going to fall under?
Sales discount.
Sales discounts, thank you. Good answer. Return allowances are what we think of as discounts. But sales discounts should be called cash discounts. We'll call it sales discounts. Here's our $2. Okay, so we're still at 100. Well, let's try something different. Let's say we returned Let's say we return $20 worth of stuff. So what's the entry for that? Well, we're going to reduce, we're going to have a returns and allowance account this time. Sales returns. Come on, stop. I gotta turn that off. Are you seeing that stuff flash on screen when it comes? No, yes. I got sales return to $20, and I've got to reduce my accounts receivable $20. So now, what's the balance in accounts receivable?
80.
Well, I now have accounts receivable that started at 100, and I credited 20. I've got $80 left sitting in my AR. So the discount I'm going to calculate, how much cash am I going to get now? Well, what's 2% of $80? What's 2 times 8? 16, so it's $1.60. I'm going to get $80 less $1.60. So I'm going to get $78.40 in cash. I'm going to clear my accounts receivable for the remaining $80. And I need to balance this with that $1.60. In this case, it's still going to be sales discount. Everybody see that?
Easier.
So I have returns and allowances, or sales returns. I probably should put R and A, returns and allowances, but you get the idea. So now our receivables are clear. We just cleared $80 out of receivables. And we're good to go. Now, this is not an adjusting journal entry. Why? Because it has cash. So let's talk about AJEs for a minute. Adjusting journal entries. It says no cash, 1 balance sheet account, and 1 income statement account. We're basically moving assets down to expenses, or liabilities to revenues, unearned revenues. Or we're recording expenses and a liability. Or we're recording revenue and a receivable. We're making an adjustment. Recording wage expense to recognize wages that we owe, but that we haven't paid yet or booked yet in any way, shape, or form. So we have the estimates called accruals, and then the adjustments, which are called deferrals. And if you want me to go through any examples of that specific, I'm happy to do that as well. And the other thing that'll be on the exam,
Wait, I do have a question about the format.
yeah.
So you said it was going to be mostly multiple choice. What about questions when it comes to like doing an adjusted journal entry? Is that going to be like a multiple choice answer?
Yeah, I'm not going to ask you to have a journal entry in good form that has the date, the description, the debits, the credits, the dollars. I
Yeah.
might on the final, but on the exam, I won't.
Okay.
There'll be
Okay.
multiple choice that show journal entries. And you'll have to pick the right journal entries. The bottom.
All right. Cool.
So it'll be easier that way. That's a good
All right.
question.
Thank you.
So is this gonna be on Connect or it's gonna be like on Blackboard?
It'll be on Blackboard through Connect. So the short answer is yes and yes. It's going to be on both. I mean, it's going to be created in Connect, and you can access it directly at Connect, or you can access it through Blackboard because it'll be posted to our Blackboard account.
Be open all day Monday.
It's going to be during your class period. So if you're in the 10:30 class, 10:30, 11:30, you will be able to access it.
Okay, so we only have access to it for that 50 minutes.
You start it during that 50 minutes, and then you'll have 50 minutes to an hour to complete it. So let's say you start at 11 o'clock. You'll have till noon or 11:50. When I get the final, now that we know it's going to be 5 chapters, I'll see the timing, and it's either going to be a 50-minute exam. I usually time it for 50, and I give you 60, so I give you some slack. But you're going to be working, and I may end up scaling the exam too. If a lot of people don't finish, which sometimes happens to my exams, you're getting through and you're saying, I got hung up and I got caught up in this problem. I didn't strategize real well. I spent 10 minutes trying to do this one problem, and I should have spent 2 minutes. Now you're behind on the rest of the stuff. So you want to strategize, and really, if you got something that you want to come back to, go ahead and come back to it. But I want to make sure that you're comfortable that it is a time pressure. And part of that is I don't want you cheating. I don't want you having, if you had 3 hours to take the exam, and I'll do open book, open note exams too. There are times I do that. This first exam, I don't do that. Because there are things concepts that I want you to internalize. I want you to have it on your tip of your tongue. So if I ask you a question, I want you to be able to come at me and say, oh yeah, I net income percentage. No, wait a minute, let me look that up. No, what's our net income percentage? Oh, I'm gonna take my net income and I'm gonna take that down here. I got my net income, I got my revenue. Okay, I got that, we're good. I don't need to look up the formula. You should be internalizing that by this point. That should become second nature to you. So when you're in a finance class, you're in a management class, you're in a marketing class, even marketing folks wanna make profits. What are you gonna sell? You're gonna sell the stuff with the biggest margin because the company's gonna make the most profit and you're gonna make the biggest bonus. So do you wanna know this stuff as a marketing person? You bet. As a management person, you have overall responsibility for profits. You gotta know this stuff. So I want you to internalize these terms. I want you to understand these formulas. I want you to have them not only tip of your tongue, but top of mind so that you can quickly say, 5% net income for a grocery store, that's fantastic. Target, Walmart, Food Lion, KJ's Market, Piggly Wiggly will be jumping in joy at 5%. Restaurant, yeah, most restaurants are 5 or 6%, and franchise restaurants are maybe 7 or 8%. Franchises actually do better as a net income percentage, typically. And if you got a 10% restaurant, you're doing something right, or you're overworking your employees. Maybe you don't hire enough people. You're saving money, you're making more profits, but you're gonna burn out your employees. So is more profit always better? Not necessarily, but that comes into the big picture. But once you get out of the way saying, okay, I got more profit, great. I've got a standard I'm at. I can say, why do I have higher profits? I'm comparing to another restaurant, another retailer, another manufacturer. Why is Motorola making less percentage than Apple on their phones? Or LG, or any other manufacturer? I don't know. Now we need to go to the income statement and say, who's got more SG&A? What's the gross profit? Maybe they're paying more for their supplies and Apple gets a better deal when they buy in volume. Or maybe Apple's manufacturing more of its own stuff and they're not paying the retail, somebody else's margin to buy some of that stuff, and they're keeping more. It's vertically integrated or vertical monopoly. So they got the raw materials, they make the chips, they go ahead and assemble the phones, and they had to make the plastic molds, and they do everything internal. I don't know, but you can analyze that once you understand, oh yeah, they're making more money. And then you can say, do I want them in my 401k or my retirement plan? Or do I want to invest in them? Or even more important, when you get out of school, do I want to go work for them? Are they making enough money that they'll be in business 5 years from now? Or have they been running losses for the past 5 years? And I'm going to get hired. And you know that? LIFO is not just inventory. LIFO is employees. So I'm the last employee to come in. I'm the first one to get canned. So you think about that and you say, oh, that's interesting. Am I going to be going to a company that's losing money and they go out of business? I'm out there looking for a job. Or, as I say, you're going to be using Edgar when you interview for a company. If they're publicly traded like Sunoco, you're going to look at their annual report. You're going to do some of this financial analysis we just did on a fictitious company, on fictitious numbers, and you're going to be able to ask some very intelligent interview questions. Last year, you were 10% profitable. Now you're down to 8% or 7%. Any insights onto why your profits are down this year? How can I help raise your profits? What is my contribution going to be? If I was interviewing somebody that came with that question, I'd say, dang, you looked at my financials and you want to make a contribution and you're asking me how you can make a difference? I love that question. And here's my answer. When you come on at this department, when I hire you, because you just asked a great question, when I hire you, here's what I'm going to need you to do. I'm going to need you to be conscious of the expenses. I'm going to need you to be efficient and effective. I'm going to need you to work as a team, whatever it might be. But that's the kind of question you'll ask that will impress an interviewer and you'll get remembered. And even if you're not an accounting major, especially if you're not an accounting major, and I think I told you, one of my marketing program director at my last school, he asked the markup question. I've got a $70 item it cost me to make. He was an executive at Smuckers. He ran their Australian and Asian operations, manufacturing and sales. And he was a marketing guy. And he said, give me 20% markup on that $70. And if you could calculate 20% markup, well, $70, 20% of $70 is 7 times 2, that's 14. It's $1.40, that's 20%. Oh, no, it's $14. I got to do this decimal right. So 20% of 70 is $14. 20% markup goes from 70 to 84. He expects you to be able to make that calculation in your head. You're not pulling out your phone and calculating, saying, oh, let me calculate what's 20% of 70. Let me add that to my 70. That's 14 plus, that's $84. He doesn't want you to keep doing that. He wants you to have it on the ball enough to say, oh, I got to sell that for $84 if I'm looking for a 20% markup. Yes, you should have those kind of things on the tip of your mind, not in your book, not on an app, not in the notes. This is something that you'll be asked on an interview and you should be able to answer in fairly short order. Or go through the process. Maybe you do a math error, they're not going to kill you. Let's see. So I'm going to take, and do verbally, I'm going to take 20% of my $70 and I'm going to add that to the 16 plus 70, that's 86. And then you might catch yourself saying, oh, no, yeah, it's 14, not 16, my mistake. But if they see your logic and your thought process as you're interviewing, and say you make a math error, they'll say, oh, I'm used to my, I got my calculator crutch, but 86 is what it would be taking that 20% markup, and you go through the process. The same way if you take an exam, most accounting exams, if you go through and say, here's how I calculate the numbers, and you do a typo or manual calculation error, I'm going to give you credit for majority of the question anyways. But I can't do that on a multiple choice. But I can do it if you're doing the work, if you got a fill in the blank or a quantitative answer, you're making a calculation. I can see what you did. Now, if you inverted current liabilities and current assets, that tells me you don't really understand current ratio. Or you put cost of goods sold in the denominator and average inventory in the numerator, you get the two right numbers, but you got it backwards, and the answer you get doesn't make sense. So there's logic here as well. So you should be able to look at any answer and say, I've got 200-to-1 current ratio. Huh? That's bizarre. I've got 0.2 current ratio. That's even more bizarre. It may be true. I've got negative 20% net income percentage. I could be losing money. or I got a positive 5%. But if you told me I have 60% net income percentage, I'm going to ask, do you believe that? Because 60% net income percentage, if you're trying to sell stuff legally, you're not going to get that far that fast. Typically, there are exceptions. There are some very profitable companies. Banks are historically very profitable. They can be 30, 40% margin. Apple, you saw, was 22%, 20 to 25% typically. But a grocery store at 15%, what's wrong with this picture? Retailer, department store, 15%? I don't think so, not typically. Unless they had a boost this year for whatever reason, they had a one-time huge sale or a huge profit. They sold off one of their businesses and they had a huge gain. But again, you got to look at the details and find that out. And finally, for our exam, we have our old friends, LIFO, LIFO, FIFO, average cost. And I told you I'm going to emphasize periodic as opposed to perpetual, and specific ID. And by the way, there are some videos. If you haven't watched them, I did a lecture on this. All my chapters have videos. So if you want to use those for review, you can do that well. You can use Ben and Boz for review. But if you haven't seen my other videos, it's stuff I do in class too. So if I confuse you in class, I'll probably confuse you on the video. But if there are any problems you want, didn't receive any. My intermediate class, I had a couple of requests. So I put some 0-point problems and exercises and brief exercises for my intermediate class, financial reporting class, that people can do. Cash flow statements is what we're doing for this test, among other things. But if you have other problems, inventory problems, income statement problems you want to have posted that you can practice with and have answers to those problems, there'll be 0 points. I'll put them available to everybody, but you won't lose credit for not doing them. But they'll be available to you if you like. Anything else before we part company? Was this helpful? Or are you feeling overwhelmed? Are you feeling things have improved a little bit? Are you feeling better or worse? Give me a thumbs up.
How many questions are going to be, do you think are going to be on the exam?
Probably between 40 and 60.
More leaning towards 40?
Is that the dream?
Yes, that'd be nice.
Probably.
Okay.
Frankly, it depends. It depends. If I ask you a question and some of the concept stuff, if I ask you a materiality question or a conservatism question, that you should read that in 10 seconds and be able to answer that. You either can or you can't.
Yeah.
If you have to research it for 3 minutes or 5 minutes, you lose. But if you're top of mind saying, and I can calculate net income percentage, and I gave you the 100 and the 10, and it was 10%, you should be able to do that in under a minute. Now, if I give you an inventory turnover problem, yeah, that'll probably take you a minute or two. If I give you a LIFO or FIFO problem, that'll probably take you 3 or 4 minutes. And I understand that. So yes, the number of questions will be tuned in to the time I think it's going to take. And I use a triple factor. I say, if I can do the exam in 15 minutes, it's going to take my average student 45. And so I've done this before. You haven't. And I appreciate and understand that.
Thank you.
No, you don't feel like you're going to be penalized because you're new to this, because you're all new to this, and I understand that. How are we feeling?
Better.
Better. Okay.
Yeah.
Thumbs up, thumbs down. Useful or thumb in the middle? Okay. Not too many downs, which is a good sign. I got some kind of neutral. I got some thumbs up, so thank you. So it sounds like it was at least worthwhile. Hopefully, if you have questions, I'm available this weekend. You won't be able to schedule on Calendly because I only do business hours on Calendly. But if you want some time this weekend, I have time this weekend to review with you, and I will make time. Send me a couple of email requests with some option times if you want to review anything or talk about anything. I'll make myself available. And I'll be checking email every day, actually multiple times a day. So if you get me by tonight, I can get you back by the morning and schedule a time. Anything else on your mind?
Not at the moment.
Okay. So I'm gonna stop the recording.